Hello and welcome to Bloomberg Quint, India's first live streaming business news service. You're watching Thank God It's Friday. I am Agam Vakil.
And I am Shraddha Babla. And joining us on the show this week is Sanjay Mookim, the director at Bank of America Merrill Lynch. Sanjay, it's a pleasure to have you here with us on Bloomberg Quint. I want to start
Pleasure being here. Thank you.
I want to start off by asking you about the current state of the Indian economy, especially in the backdrop where Brent crude has actually risen to 69 now, and what seemed to have worked in favor of this government has actually started to turn now. And of course, that doesn't come at a very good time, given that export growth is lagging. There are concerns on the fiscal front, investment demand isn't picking up. So just your thoughts on where the economy stands currently.
Right. Now, I will answer that in two parts. First, I think in the short term, we have hit what I call peak macro. And this is to confirm what you said, is that on most metrics, whether it is the current account deficit, the fiscal balance for government, bond yields, inflation, a lot of the tailwind that India has had over the last 2 or 3 years seems to have turned. And as an aside, the equity market seems to take notice of that currently. But yes, we are in a slightly more difficult spot than we have been, and the policymakers and government will need to make some tougher choices in the near term. However, the positive news is that the government has, over the last 2 or 3 years, instituted major reform. And we all know of them, whether it is the bankruptcy court, the GST, the Real Estate Act. All of these, to my mind, are extremely powerful changes. This causes turbulence in the short term, disruption, and there are many words to describe it, but you get the sense. But the long-term benefits of these reforms are significantly powerful, and we will continue to accrue the benefits of these for years to come.
Right.
So in the extreme short term, yes, we've hit peak macro. The government has its hands tied tighter than it was previously. But in the medium term, there can be tailwinds that will arise from the reforms that have been instituted. So a bit of a mixed bag, really.
Right. Okay. Sanjay, I couldn't help but notice that you estimated the Sensex to be at around 32,000 by the end of December 2018. Does that mean that we're, and there are expectations that earnings could catch up? So does that mean that while earnings will catch up, we may not see as much of an up move for at least the large caps then?
That's right. And the reason I say this is that there are two variables broadly which drive equity prices.
Right.
One is the earnings themselves, and then there is multiples. In theory, multiples are correlated to earnings growth. So if you have higher earnings growth, the multiples should be going up. But what has been happening in India, and perhaps the rest of the world really, is that multiples have gone up outside of earnings growth. They've gone up on the basis of liquidity injections, on the back of a global equity rally really, and that is cyclical.
Right.
So while I agree with you that Indian earnings should improve in FY19 over FY18, in fact, we ourselves forecast an acceleration. Part of it is the economy doing better, part of it is just a base effect, because we've had a bad FY18-ish. Nevertheless, the risk is that the multiple itself turns down. So while sitting in India, we focus on India-specific factors, we focus on how the economy is doing, the multiple cycle is actually a bit of a globally correlated asset rally. So my worry really is that what we're not focused on, what we're all aware is happening, is the bigger risk to Indian equities this year than perhaps the earnings themselves.
All right. So Sanjay, what influence can the 2019 general elections have on government policy? And in that case, what does it mean for equity markets in India?
Okay. So the classic response to that would be to expect the government to be a little bit more populist getting into the elections, or at least try and avoid measures that might hurt them politically.
Right.
From an expenditure perspective, this means that the government will have that much more incentive to continue with their social spending, increase spending on rural housing, roads, stuff that has impact immediately, not 5-year road building plans or airport building plans, because those are good to announce, but it doesn't affect your vote getting power in the short term. So you'd expect the government to swing from very capex-oriented expenditure to very revenue sort of short-term focused. From a market's perspective, that may have mixed effects, right? Infrastructure sort of sectors may lack momentum from expenditure, but rural consumption-driven stocks could see some tailwind going forward.
Right.
Of course, the trouble for government is to find the money to do this. Okay, the budget is tight. There is chatter that they might consider an expansion of the deficit, one time perhaps, and it may be politically necessary for them to do that into the general elections.
Right. Okay.
Sanjay, is it fair to assume that nothing major can be expected from the budget in terms of big bang reforms, given that the reform measures like you measured, whether it be bank recapitalization, the real estate, IBC, all of these have already been, GST have already been passed last year itself?
Yes, increasingly the budget is becoming less of a platform for major changes, right? And especially now with the GST, the whole indirect taxation piece is also taken out of the budget. And therefore, the chatter you read in papers is about direct taxation, about capital gains tax, about personal income tax changes. Because frankly, that's about stuff that is left in the budget, the fiscal deficit number and direct taxation. So I do not expect any major surprise in terms of policy changes in the budget. And really nothing constrains the government from having to do everything in the finance bill. So no, I wouldn't expect major reform kind of changes other than for tax rate changes which may or may not happen.
You just address long-term capital gains. I just wanted to understand how real is that possibility?
Well, you know, if you think about it, it's market chatter on that picks up every year, just ahead of the budget, as you know, this big taboo, this scaring monster that might come out of somewhere. I don't know if the government is serious about it, and frankly we won't know until the budget actually comes out.
Right.
But the market does think that there is a probability it happens. We'll see.
Right. So Sanjay, you know, from an investor's point of view, and I know that there's very little correlation between what happens in the union budget and you know, the implications on listed entities. Yet, what would you as an investor look forward to in the union budget?
Okay, first of all, the big number would be the fiscal deficit, and the reason I say this is because it has an impact on bond yields. If the government were to one time increase the deficit to, let's say, a 3.8 or 4, a meaningful step up from 3.2, then that means a significant issuance of bonds, which means bond yields go up.
Right.
Now, in theory, that should have a negative impact on multiples in India because your alternate cost of capital is going up.
Right.
Sector-wise, higher bond yields can exert pressure on certain NBFCs, for example, who rely on wholesale funds for their operations.
Right.
So there can be some sector-wise implications as well. That's the one big number really from the budget. Taxation-wise, yes, personal income tax cuts, if they were to happen, could stimulate demand and make some changes to the prospects of consumer companies, discretionary staples. Capital gains tax, as we discussed, could be another issue. But really, I don't see too much beyond that.
Right.
Any expectations from the budget specifically for banking sector? And I'm asking you this because bank recapitalization has already been announced, but anything possibly you know, on PSU bank consolidation or on the housing front perhaps?
Look, on the consolidation, again, the budget is not the platform to make any decisions on that front. And frankly, I do not think that, you know, the corporate governance metrics allow the government to make a decision. The boards of the banks need to agree to do the mergers and so on. So, the union government can't just simply make the announcement that these mergers will happen. Maybe an intent statement of some sort is put in the budget.
Exactly.
But firm execution or progress of this consolidation cannot happen in the budget by definition. Right.
Right. So, Sanjay, you know, I want to move out of the budget and I want to address the commodities, specifically crude in this case. At what point in time do you think that crude can be a real threat, a considerable threat to the Indian economy? We have seen it move around the mark, well over the mark of $60 a barrel right now. What would that mark be for you then?
I think that mark was 2 months ago. Frankly.
Okay, all right.
It's not something in the future. We are already in some sort of trouble because of the crude price.
Okay.
And let me try and elaborate what I mean.
Right.
The oil ministry every year is handed out a budget for paying the LPG and kerosene subsidies.
Right.
For the first 3 years of this government, the oil ministry has stayed within that budget and they've been managed to live within their means. This year, the ministry has run out of its budget in the first half and has to go back to the finance ministry to ask for additional money to pay LPG and kerosene subsidies.
Okay, okay.
So this is the first time for the current government that they are short or running behind on oil subsidy payments already. That's why I'm saying that this is not a problem that's going to arise in the future. It's already creating a fiscal problem. My estimate is that the government this year would probably need about 10 to 15,000 crores additional over the budget to fund the LPG and kerosene subsidies. So now, in this environment, finding even 10, 15,000 crores is going to be a bit of a challenge for government. We'll see how they handle it.
Right, and if I can, put in a follow-up question to that, what could it mean for Indian equities which have exposure to the oil and gas space then, in upstream and downstream for that matter?
Well, the public sector companies which are reliant on the government subsidy policy, for they have been for many, many years, may have a bit of a risk that the government reimposes some sort of a subsidy on the companies if they were unable to find that money in their own budget. Okay?
Right.
So, and we will know only in April or May when the fourth quarter results come out whether the oil ministry has been able to fund the subsidies or not. But the probability that a subsidy problem re-arises is actually going up.
Right.
All right. Just also wanted to ask you, with respect to the key themes for 2018 that you all have mentioned in your report. You've spoken about elections in 2019, IBC asset sales, GST and real estate. Let's talk about the election 2019, please, first.
So look, I wouldn't talk about the political aspects of it, but from an economy perspective, it can be a stimulant for spending from a government angle. And I don't know whether the government will exercise the headroom on the fiscal budget, but if they did expand the deficit, if they did incur more rural expenditure, then certain sectors in India, consumers, rural focused auto companies, finance companies, they may see some sort of a near-term bump up in sales perhaps.
All right, Sanjay, the other sector that I wanted to address in this case was the real estate sector, and specifically from equities point of view, we've seen a lot of appreciation in a lot of these stocks, but the truth is that in terms of demand, we really haven't seen too much movement. Of course, RERA's come in and the implementation for the sector. What are these companies factoring in then? It couldn't possibly be demand picking up 2 or 3 years down the line.
Well, no, I think investors are looking for a very much quicker improvement in demand, and the way these cycles work, the classic example would be that volumes pick up first, and once the utilizations tighten, and then you start seeing price momentum, which is ultimately the bigger driver of real estate stock prices. But I suspect what has happened is the excitement not just on RERA, but on the affordable housing scheme that the government has launched. In many ways, the affordable housing scheme is relatively mass market. It is not restricted to very, very low income categories as well, and therefore the scope of it is very large. Even the listed developers have been talking about the prospects of affordable housing. Demand can be really strong if the housing is subsidized or the mortgage is subsidized, as you know. And that, I think, reinforces the view that investors have that the housing cycle, especially in the low pricing category, the low ticket category, might be about to improve. There are some signs that there is a pickup already.
All right.
This is just a question. You were talking about rural housing and housing finance in general. Just wanted to understand if you think that the exuberance with respect to housing finance companies, especially on the affordable housing front, is really justified, given the way bond yields are moving, and also if a recent report by a rating agency is something to go by. They have spoken about how the NPAs in affordable housing segment have risen, and they expect them to continue to rise in 2018 as well. So, is it fair to assume that the market returns from housing finance companies will be a lot more sanguine this year?
Well, I would think the market returns from the whole market will be a lot more sanguine, but yes.
You said that.
Let me talk about the housing finance companies. In that, I do not expect a slowdown in demand for mortgages. The conditions have been right. Government policy support from RERA and affordable housing, the mortgage prices falling, the real estate prices themselves coming off as well. And we do not think in our assessment that there has been any deterioration of credit standards at the lending companies as well. So there's pretty good checks and balances in the kind of loans that are being offered even now. So there doesn't seem to be an excess yet. However, every credit space, I think, is cyclical, and the cyclicality can be long or short. Even the housing or the mortgage cycle in India at some point will see NPAs, which is what perhaps you're alluding to. Yes, higher bond yields are a problem for wholesale funded banks. So from a top line perspective, we think the NBFCs should have a decent run for the next few quarters, months perhaps, at least. Okay. Profitability wise, there is some pressure. Okay. Now, the problem for the market is each of them is extremely expensive. Is the market able to digest a hiccup in profitability even while the top line is doing well?
Right.
I don't know. I frankly think that the whole market is overpriced.
Right.
Okay, one more question before I can let you ask Kwanakam. We were discussing about how, you know, if the budget actually is populist, how it would benefit some of the consumption companies. That would be a logical play then. Within that space also, how are you picking up or how are you choosing companies?
Look, I personally think that consumer discretionary companies with a slight rural bent, and that would be the autos with rural exposure, are probably likely to have the bigger delta. Okay. So from a top-down aspect, that's how we try and filter. But of course, I was hesitating to answer that question because I wouldn't want to narrow the segmenting so finely, right? Once you identified a broad sort of a theme, then we want to pick stocks bottom up. Okay, which company is executing properly, which companies got the proper tailwinds in place, and so on. But yes, to answer your questions, I'd say the rural consumer discretionary sort of names would look slightly better placed than the rest.
Okay. Sanjay, what we've seen in 2017 was a gush of domestic funds. Can we expect a repeat, maybe in not as much as what we've seen in 2017, but in 2018?
Well, as things stand today, there is no slowdown in domestic liquidity, right? Even in the month of December, we've seen upwards of 20,000 crores of money flow into mutual funds. Possibly it continues. And we did some analysis today, is that while people focus on the gross inflow, the net inflow has actually been negative. And what you mean by net is the total flows into funds and FII flow minus the equity sale, minus the issuance. So far in FY18, the issuance has been higher than the amount of money that's come into funds and FII inflows. In theory, that means that there should have been no impact on valuations at all. But valuations keep rising, and in fact, if you look at the Nifty mid-cap PE, it's gone vertical over the last month and a half. So I argue that the market's focus on flows or the gross flows is excessive. That in itself does not explain the re-rating. It's probably a more intangible sentiment factor, the global tide as it is, which is driving these multiples up. As things stand today, market going up, I don't see anything turning the flows down again.
All right. And Sanjay, finally, my question, you brought up, the part of global markets in India. In your report, you have suggested that, it's tied by the hip when it comes to the fate of the Indian markets, to a certain extent at least. What are the global risks out there that one may have to be wary about?
There's many. Which one will actually be effective, we will know only in hindsight. Okay. So there is always the concern that there is some slowdown in China, for example. US bond yields have finally started to move up. If they keep going up at some point in time, the market will take notice of it. The banking sector in parts of the world is still jittery. And every now and then you get some regulator, some concern that banks are not adequately capitalized yet. And political issues in the Middle East, in the Korean Peninsula, any of these could snowball and affect market sentiment. So far, none of this has mattered. But again, which straw breaks the camel's back, as it were, we will only find out in hindsight.
All right.
And on the just one classic debate on private versus public sector banks, just wanted to understand, given the way all these IBC resolutions are moving or progressing, at this point in time, would you actually choose to stay with the private banks which have been doing well, or do you at least see some value buy in corporate-oriented banks as well?
So within the non-private consumer, we divided into the PSU and the private corporate banks, right? So we actually like the private corporate banks. We think there is enough valuation support, perhaps enough upside. The public sector banks, I suspect, need to go through a little bit more pain. There is not just the bad asset problem on their balance sheet, but they also have to implement Basel III norms. There is the IFRS 9 coming in April. So there's a lot of stuff that will consume their capital, need for them to redesign their whole processes, which might occupy managements for a long period of time. On the IBC, we think that the market opportunity might actually also lie at companies which buy these assets from the IBC. There's billions and billions worth of dollars of assets coming up for sale or resolution simultaneously.
Right.
And it is very likely that price discovery is inadequate.
Right.
If you have 5 steel plants, major steel plants being sold at the same time, and there's only 5 buyers, it is very likely that each of the buyer gets a very good price for the asset that they are purchasing. Therefore, I mean, investors, this is a very bottoms-up approach, but investors need to keep an eye open for these situations. And if you do get a company able to buy one of these at good value, then the listed entity, the purchasing company, might be a good investment.
All right. Well, Sanjay Mookim, it was a pleasure speaking with you. Thank you very much for your time.
Pleasure being here. Thank you.
As for you guys, we have lots more lined up, so don't go away. This is all that we have in this edition of Thank God It's Friday, but we'll see you next week once again. So stay tuned into Bloomberg Quint.